So our learning objective 2, which is that compute residual income and understand its strength and weakness. So some call it residual and some call it residual. So both are correct. So residual income is the net operating income that an investment center earns above some minimum return on the assets. So this economic value added model is an adaptation of residual income as well. So if you just want to see that, we will be discussing in our Zoom live meeting that what do we mean by economic value added adaptation means. But just up till now, just remember that this is one of the extension of the economic value added model, in which you are basically adding the value to the business, and your performance is evaluated based on those on that value. So the equation for computing residual income is as shown here, that residual income is equal to net operating income minus the average operating assets multiplied by the minimum required rate of return. So this computation is different from the ROI, where ROI measures net operating income earned relative to the investment in average operating assets. So residual income measures net operating income earned less the minimum required rate on average operating assets. So these two are different measures. So one performance is evaluated based on net operating income, how much you earn, and one measure which is residual income measure, that is you are based on whatever you are required, how much is above the requirement. So we have a very short quick check for you, that the residual income, an example. So assume that a retail division of the Fire Incorporation has average operating assets of 100,000 and is required to earn 20% on these assets. So in the current period, the division has earned 30,000, right? So in simple sense, we can just understand residual income is that you are required to earn over 100,000 20%. So what is the 20% of 100,000? 20,000. So you are just given the task to earn 20,000. Instead, you earn 30,000. So here is a layman guess whether you did right or wrong, or whether you have to be given bonus or not, or your performance is good or bad, right? Since you are required to earn 20,000 and you earn 30,000, of course your performance is good. So let's see the solution. Here it is. Your requirement was the minimum to earn 20,000 and you earned 30,000. So residual income is 10,000. So you exceeded the performance. You exceeded the benchmark. So motivation and the residual income. So residual income encourages managers to make investments which are profitable. That would be rejected by the manager using ROI. So it motivates managers to pursue investment where the ROI associated with those investments exceed the company's minimum required rate of return, but is less than ROI being earned by the manager. So we are not into ROI, we are into how much money you make. So we have a quick check here. So Redmond Evering division of Wrap-Up Corporation has a net operating income of 60,000 and the average operating assets of 300,000. The required rate of return is 15%. What is the division's ROI? So can you calculate that? Just pause the video for a second and try to solve it. Since we are calculating the ROI is equal to, we have operating income of 60,000 divided by average operating assets 300,000. Answer is 20%. If your answer is D, you are in good shape. So we have added a little bit more flavor to this same question. So Redmond Evening division of Wrap Up Corporation has a net operating income of 60,000 and average operating assets of 300,000. If the manager of the division is evaluated based on ROI, will she want to make an investment of 100,000 that would generate additional net operating income of 18,000 per year? So answer this question. I'm just going to give you 5 minutes to pause the video and try to solve it, and then we'll solve together. Okay, let's do that. So now the new operating income would be, we have 60,000 plus 18,000, which is 78,000, right? We have operating assets, so since we don't have any other ones, so we just add it. So we have 300,000 plus 100,000 as well, so we have 400,000 as a net operating assets as well. So 78,000 and net operating income and net operating assets are 400,000. So what is ROI? Net operating income divided by the net operating assets, which are 400,000. So answer is 19.5%. So since in our last quick check the ROI was 20%, so look at that. The additional investment will be producing 18,000 per year and annual income. But in order to generate this 18,000, you have to invest in 100,000 in operating assets. So that will basically decrease our ROI to 19.5. So what is your relevant answer? Answer is no. So the other flavor is that the company's required rate of return is 15%. What the company wants the manager of the Redmond Evening division to make an investment of 100,000 that would generate additional net operating income of 18,000 per year. So what is your answer? Just pause the video and do it by yourself, then we do it together. Okay, so what is the required minimum level of income? That is 15% of 100,000, which is 15,000. And you make how much? 18,000. So which means the residual income is 3,000 positive. So which means yes, right? So this quick check is basically the quantification of our residual income. We just did that Redmond Evening, a division of Wrap Up Corporation, had net operating income of 60,000 and the average operating income assets of 300,000. The required rate of return is 15%. And what is the division's residual income? So you just calculated that how much they are required. The required income the manager needs to produce is 15%, which is 45,000. And how much above he has generated? 60,000 minus 45,000. Answer is 15,000, right? So if the manager is evaluated based on residual income, so will she make an investment of 100,000 that would generate 18,000, since 15% is 15,000 and the manager has earned 18,000, which is above 3,000 of the required rate of return. So the answer is definitely yes.